Inflation is causing upheaval in the markets, making everything from gas and groceries to hotels more expensive. But just because the near-term economic picture is negative doesn't mean you should stop saving and investing. However, you may want to give your portfolio a once-over to see if you're positioned in the most recession-proof manner possible. No investment is completely immune to an economic downturn, and markets can always be unpredictable, but some investments are traditionally more resilient during difficult economic times. In this episode, we'll explore 8 recession-proof investments to consider in 2022. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos on the best strategies to deploy to stay on top of your investing game. Here's a look at some investment options to consider to recession-proof your money. 1. Recession-proof industry stocks. The best 3 categories of recession-proof industry stocks include pharmaceutical stocks. Pharmaceutical stocks, a subset of the healthcare industry, are traditionally considered defensive, along with other industries like utilities. This is because even in the midst of an economic crisis, people need medication and to be treated for illnesses. As an example, if you're on a blood pressure medication, you're not likely to stop taking that when a recession comes. More likely, you're going to stay on your medication even if it means that you have to find a new way to pay for it. This and countless other examples demonstrate why healthcare stocks can still be a good play even in an economic downdraft. Example fund. The Fidelity MSCI Healthcare Index ETF, FHLC, offers broad exposure to pharmaceutical stocks. Grocery stores. Grocery stores run on thin margins, which can make them tricky investments. During recessions, however, grocery stores often have an uptick in sales and profitability. As consumers trim their spending on eating out at restaurants, they tend to buy more groceries and eat at home. Even during the bleakest of recessions, people still need to eat, and grocery stores provide this necessary service in a more affordable package than restaurants. Utility stocks. Utility stocks fall into the same defensive necessary category as grocery stores. Even when consumers trim back their spending, they still need water coming in through their pipes and power coming in through their lines. There will always be a demand for the products utilities provide, even during a recession. Utility stocks also tend to pay high and consistent dividends, which makes them more appealing to investors looking to get defensive. Example fund. The Vanguard Utilities Index Fund ETF, VPU, is a cheap and broad way to buy utility stocks. 2. High dividend stocks. High dividend stocks are riskier than FDIC-insured products like savings accounts and certificate of deposits. However, their potential for return is higher. During the market sell-offs that usually accompany recessions, high dividend stocks may hold up better than others because investors are getting a cash return in addition to the potential stock price return. High dividend stocks also tend to be more mature companies with significant cash flow in defensive industries, which adds another layer of protection against wild market swings. You can still lose money on high dividend stocks in a bear market, but you'll be protected somewhat by the incoming cash payments and the high survivability of companies like this during recessions. Example fund. The Vanguard High Dividend Yield Index Fund Investor Shares, VHDYX, offers a diversified portfolio of dividend stocks. You can also look for individual high-yield dividend stocks. 3. Precious metals. Precious metals like gold and silver are often in demand during stock market sell-offs and times of overall economic unease. The reason is that precious metals are seen as a store of value, something tangible that investors can physically hold on to, while their intangible assets like stocks go down in value. Gold also tends to rise during low interest rates environments. Since gold doesn't pay a dividend, it becomes more attractive when other instruments are not paying much income either. Example fund. For a mix of metals, try the Invesco DB Precious Metals Fund, DBP. For gold alone, check out the Granite Shares Gold Shares Fund, BAR. 4. Commodities. Commodities are raw materials such as metals and grains that can be used singly or as components of other products. Long considered a potential hedge against inflation, commodities give investors a few ways to invest. The easiest and perhaps one of the less risky is through a mutual fund that invests in businesses that are involved in commodities, mining, energy, or agricultural companies, for example. Example fund. Try the Invesco DB Commodity Index Tracking Fund, DBC, for exposure to many types of commodities. 5. Rental properties. Housing as an investment isn't particularly recession-proof. In fact, during major economic traumas, housing prices tend to go down, although that hasn't been the case in the present downturn due to the effects of the pandemic on the housing market. But rental properties can still be defensive in economic recessions because of the passive income they provide. With record high prices keeping many would-be home buyers out of the market, prospects for owners of rental properties could be especially good. The same caveats in choosing a rental property, such as being sure to choose an in-demand property in a well-located area and understanding the work and risks involved in owning a rental property, apply whether or not you're buying in a recession. 6. US Treasuries. US Treasuries are the gold standard when it comes to safe investments. These securities are backed by the full faith and credit of the US government, meaning the US Treasury has your back when it comes to getting paid on your interest and principal. While your risk of default is essentially non-existent, you'll have to deal with interest rate risk if you sell your treasuries before they mature. The longer the maturity, the more your price will go down when interest rates rise. To minimize this risk, hold your treasuries to maturity, only invest in short-term options, or build a ladder with a maturity coming due every year. Example funds. You can buy a fund such as the Fidelity Long-Term Treasury Bond Index Fund, FMBGX, or go straight to the source and buy bonds from the US Treasury Department. 7. Certificates of deposit. Certificates of deposit are in a similar category to savings accounts when it comes to safety. Both are insured by the Federal Deposit Insurance Corporation up to $250,000 per depositor. CDs typically pay higher rates than standard saving accounts and may pay as much or more than high-yield savings accounts. However, a CD often locks in funds for a set amount of time, so you won't have easy access to that money. If you don't think you'll need that money anytime soon, a CD can be a good place to ride out a recession and keep your funds safe until you can reinvest your money into investments with higher return potentials. 8. Hedge funds. Hedge funds are typically high-risk, high-reward investments that try to turn a profit in any type of market. Hedge funds accomplish this through the use of advanced investment techniques and securities such as selling short, hedging, arbitrage, and futures. To invest in a hedge fund directly, you generally need to be an accredited investor, which means you'll have at least $1 million or more in net worth to go along with investment experience. However, now various mutual funds and other types of investments allow everyday investors to get access to hedge funds. During a recession, a skilled hedge fund manager may be able to outperform a so-called long-only manager who is forced by the rules of the fund to always be buying stocks even when the market is declining. Is it safe to invest during a recession? During a recession, stock values often decline. In theory, that's bad news for an existing portfolio, yet leaving investments alone means not locking in recession-related losses by selling. What's more, lower stock values offer a solid opportunity to invest on the cheap, relatively speaking. As such, investing during a recession can be a good idea, but only under the following circumstances. You have plenty of emergency savings. You should always aim to have enough money in the bank to cover 3 to 6 months of living expenses, with the latter end of that range being more ideal. If you're there and have extra money at your disposal, you can feel free to invest it. If not, be sure to build a solid emergency fund first. You're not planning to touch your portfolio for at least 7 years. Investing during a recession isn't for the faint of heart. You may think you're buying at a low, only to see your portfolio value decline a few days later. The best way to avoid losses in a recession and come out ahead is to take a long-term approach to investing. Plan on leaving your money alone for at least 7 years. You're not going to obsessively check your portfolio. When the economy is in bad shape and there's lots of stock market movement, you may be more inclined to log on to your brokerage account every day and see how your portfolio is doing. But if you're going to invest during a recession, you simply can't do that. The more you check up on your investments, the more likely you're to panic. And when you panic, you risk making rash decisions, such as unloading poorly performing stocks that force you to lock in losses. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.